Hi, I'm David Stein of Money for the Rest of Us, and in this video I answer the question, what are bonds and why should you consider investing in them? Bonds, also known as fixed income instrument, are investment securities issued by governments, corporations, and other entities. They pay interest. When a government borrows or issues a bond, they're essentially borrowing money, and they're going to pay interest for the use of that money. And at the end of the term, at maturity, they're going to return the amount that was borrowed, or the principal. As investors, we can invest in bonds. We can buy bonds directly from the government, or we can buy bonds in the secondary market, individual bonds issued by the government or a corporation. Or usually we invest through a bond mutual fund or a bond exchange traded fund. Now, there's some certain principles you need to understand when it comes to bonds. First, we own them for the income. We want to get that yield, those interest payments. But another reason individuals or businesses own bonds is they want to benefit from capital appreciation. They want the bond to go up in value. And the way that bonds go up in value is the interest rate falls. As rates fall, the value of bonds go up. And as interest rates rise, the value of bonds fall. Why is that? Well, if you own a bond, let's say it's a 3-year bond and it pays a 3% interest rate, you own it, and then the government issues a new 3-year government bond at 4% interest rate because rates rose. Well, if you can get a new bond for a 3-year term that pays 4% and the old bond only pays 3%, then the old bond's price needs to fall to a level where an investor would be economically indifferent between owning the different bonds, that they would have the same return. And so the value, the price of that 3-year, 3% bond has to fall to such an extent that if somebody went out and bought the bond, their total return owning it, their annual return each year would be 4%. And so bonds fluctuate as interest rates change. Now that's important. When we look at the way the fixed income market is in the US right now, the yield on 10-year government bonds is 2.14%. And the yield on short-term 30-day Treasury bonds is about the same. Actually, it's a little higher. Why would you own a longer-term bond, whereas if you owned a short-term bond, you would get the same income? Well, you would only do so if you believe interest rates would fall. In a typical environment, you actually would get more income by owning that longer-term bond. You would have a higher interest rate, but not right now. Now, why might interest rates fall from here? Well, one reason is the Federal Reserve, the U.S. Central Bank, has said that they're going to be patient and not raise interest rates. In fact, they've even talked about cutting their short-term policy rate. And one of the things that influences interest rates, longer-term interest rates, is what investors expect the central bank will do in terms of what the future short-term rates will be. Well, will short-term rates be lower a year from now or higher? And that influences the longer-term bond interest rate. And right now, investors expect the Federal Reserve to cut interest rates. And so as a result, longer-term yields or interest rates are higher or lower than short-term bonds. Another reason interest rates could fall from these levels is because the yield you get in the US, as I mentioned, is about 2.14% on a 10-year government bond. A 10-year government bond in Germany has a yield, an interest rate of negative 0.2%. And in Japan, the interest rate is 0. And so because yields are higher in the US than they are in Germany, Japan, and other developed countries, that can kind of put a ceiling on what US government bonds might yield. Not a guarantee, but those are things that could put some downward pressure on interest rates. What could cause rates to go up higher from here? Well, one is the supply of new bonds. The US government's been increasing the supply of government bonds by 5 to 7% per year because they're running a rather large deficit. The amount that the government's spending is more than what it's taking in tax revenue, so it's having to issue new government bonds every year. That more supply, and if the demand isn't there, that could cause rates to rise. Another reason interest rates could rise is investors demand additional compensation, what's known as a term premium, for uncertainty. Uncertainty regarding inflation, uncertainty regarding what the Federal Reserve is doing. And interest rates could also rise if inflation expectations increase. If inflation starts to pick up. So interest rates could rise from here or they could fall from here. As an investor, we have to decide, do we just want to own bonds for the income, or do we want to speculate on what interest rates might do and potentially benefit from capital appreciation if rates fall? In my personal portfolio, I don't own long-term bonds right now because I'm not getting compensated for it. Instead, I own other asset categories that benefit from falling rates, or if rates stay the same. These asset classes have a much higher yield than bonds. An example would be preferred stock, which yields 5 to 6%. This is a stock that trades like a bond. It fluctuates as rates change, but it has a much higher dividend payment. Real estate investment trust is another asset category you can own that has a dividend yield about 4%, and it benefits also from falling rates. So you don't have to own bonds. I own it for the income. I also own it for the optionality, to preserve my capital, to preserve money, so when other opportunities arise, I have some safe cash that I can go and invest in that. So that's how bonds work. That's why you might consider investing in them. If you have any questions, you can put those below in the comments. Thanks.